Hello everyone, welcome back to Lab for Crypto. Today we are going to have a discussion about hodl waves. Hodl waves are very useful in understanding the behavior of the long-term and short-term investors in various blockchains. We're going to use Bitcoin as an example, but of course you can explore more assets in our platform. If you like the video, please give us a thumbs up and also leave us a comment as this will help the YouTube algorithm show our content to more people. Let's dive in and understand the information that we can get from also the historical data of hodl waves and see if it can help us make informed decisions before the next bull cycle. Let's dive in. Hodl waves are split in various regions. That's why you see all these colors in the platform, and I will explain them in a bit. But let's first see what the definition of hodl waves is and what they tell us. Hodl waves reflect what percentage of Bitcoin supply in this case has been unused in a transaction for a certain period of time. So when we have the 1 week to 1 month period, that means is the percentage of the Bitcoin supply that it has not moved between the period that we see, which in this case is the 1 week to 1 month. And if we check the current number, today 3.9% of the Bitcoin supply has not moved. But what these numbers tell us in short is the behavior that various investor brackets have. Someone that has a longer vision for Bitcoin, you will see that it does not have the same he or she has not the same behavior that someone that just heard about Bitcoin, for example, entered the market when he saw high volatility, which is something that is observed in the crypto in general. He immediately exit. He didn't have the stomach to withstand this high volatility, and that is observed in their behavior. For example, when you see this, if we see the orange line on the previous all-time high of Bitcoin previous on 2017, you will see that people usually enter just before a previous all-time high, and when they see a high volatility, they start to move their coins and they start to exit immediately because they're afraid. And unfortunately, in some cases, the timing is not ideal. And if we see the 2021 and compare it with 2017, you will see that when we breach the 2017 all-time high at the time on 2021, we had immediately a spike in the number of users that joined the market, and they immediately left when they saw a drop in Bitcoin price and when it moved from 40K to 33. And after Bitcoin started to go to higher prices and moved to the first peak at the 57K, they start again to join the market. But in short, you'll see this high volatility also on the addresses that are not here for the long run. And you can observe the same with the 1 month to 3 months period. Again, they start to accumulate when the previous all-time high is breached. They come into the market and they immediately start to leave the market. But when we check higher time frames, you will see now that this line is not that volatile if we compare it with the shorter time frames. And the reason behind this is people that they already study Bitcoin, they already believed in it, they enter when Bitcoin was really cheap, they understand the cycles, and it's useful to understand their behavior. And if we take, for example, the second peak of Bitcoin in 2021, these people tend to not to move their coins when something happened. For example, imagine that was the COVID dip, and these wallets did not flinch at all, and you will see that the number the percentage of the supply that did not move continued to increase. On the other hand, if you see the short-term um, the short-term holders, they immediately we saw a spike because they started to move their coins. That's why you see the drop between from 8.6% to 3.67. And let's move to the longer time frames again. Oh, sorry. The 2 to 3 years, you will see the behavior of, for example, on the COVID dip, they didn't flinch. And as we started to move to the previous all-time highs, they start to slowly offload some of their BTC. And also, when we see a sharp drop, that's an indication that these kind of investors believe that the Bitcoin top is in. And that is why when we start to drop, they start to accumulate again because they have a longer time frame. And when Bitcoin drop to the bottom, you will see they continue to accumulate and they they hold their coins in short, and you will see this number going up, and from 6.5% it moved all the way up to 16% roughly. And now that we are approaching the all-time high, they start to offload some of their Bitcoin. And that is fine in my opinion, because these people have a longer time frame. And of course, usually they don't offload all of their Bitcoin. They they move, they DCA out and they DCA in. That's why you see this low volatility in these numbers. And therefore, it's important to us to check if there is a sudden drop, and these investors, which they are more experienced, what they are doing. And of course, we have also the longer time frames, which of the likings of people that they enter really early in Bitcoin, or Michael Saylor, which is someone that he says that he never is going to sell. And this, and of course, coins that are lost. But anyway, it's always good to check the behavior of the long-term time frames and the short time frames. As the short-term time frames, it tells you if the retail is in the market, and when we start to see this high volatility, that means that possibly the top is in. And also the behavior of the long-term investors, which usually they slowly offload, and when they think that the top is in, and an example was in November 2021, you see sharper declines. I hope I explained the hodl waves well. If you like the video, please give us a thumbs up and leave us a comment. And until next time, bye bye.